ma'am. How are you doing?
Good morning.
Good morning.
Welcome to the Senate Finance Committee. Today is Wednesday, January 22nd, and the agenda this morning is the fiscal briefing. So, Mr. Romans, would you like to come to the table? Do you have someone you'd like with you?
Yes.
Thank you.
Thank you, Madam Chair. Kate Hayward from our staff is here to help keep me on the right page so I don't get lost here. My goal today is to just give you a quick overview of the fiscal briefing and really answer the questions you have rather than me talk a lot. Starting at the first page of the document you should have, overall fiscal 26 budget is $67.3 billion, about an $800 million increase over fiscal 25 or 1% growth. General funds actually declined by 1% or about $274 million, and that's largely due to cost containment in the budget. Key points about the budget: on a cash basis, it's balanced with a $106 million surplus at the end of fiscal 26. The rainy day fund has over $2 billion in it. That's 8% of general fund revenues. Spending Affordability Committee had a goal for structural balance for fiscal 26, meaning ongoing revenues and ongoing spending are equal, or revenues are more. The governor failed to meet that goal, came up $186 million short, so the General Assembly will need to make additional cuts and or raise additional revenues in order to erase that structural gap. I would note there's been one time in 40 plus years that the Spending Affordability Committee goal was not achieved, so I think it's likely that you will try to achieve that goal. The Budget Reconciliation and Financing Act is a key component of the balancing plan. Page 2 provides a summary of the biggest items. There's a lot of items in the Act. There's, I think, over 100 items total, so I don't have them all summarized in this chart. Overall, the BRFA has about $3 billion of actions in it. These are not the only budget actions. There's other actions that can be taken in the budget bill that don't require changes to legislation, but anything that requires legislative changes to statute appears in the BRFA. So under revenue adjustments, you see there's about $1.3 billion of actions. The largest, almost $700 million, related to personal income tax reform. I will talk about that more in a moment. Other one that I would note of interest is there's a capital gains surcharge on personal income that's proposed that would generate $128 million additional revenue. There are also increases in the sports wagering tax and the table game tax rates that go into effect in the current fiscal year, generating combined about $136 million to help balance the budget. There are significant transfers to the general fund from various fund balances, the most prominent being from the local income tax reserve fund, taking $230 million. There's a payback provision that would start in fiscal 29 to pay that amount back to the fund over 10 years. Spending reductions are the other major component of the BRFA. Over $1 billion of spending reductions. The biggest single item is a reduction to the appropriation to the rainy day fund. So the governor was required to put another $420 million into the rainy day fund. He's saying, let's not do that. We've already got $2 billion in the rainy day fund. More policy-oriented cuts include, and probably of interest to this committee, there's a Medicaid hospital assessment. It's been in place for, I think, about 15 years. In recent years, it had been coming down a little bit. The governor is proposing to increase it on an annual basis by $100 million, which gets it back to kind of the high point, just around $400 million a year. And that is a permanent change in the statute. So this is an assessment on hospital charges. Most of it is paid by the payers when they, the insurers and individuals when they use hospital services. A small amount of it is usually absorbed by the hospital industry. The money then goes into a special fund that supports Medicaid costs, saves the general fund money. There's a cost shift to local governments related to K-12 teachers' retirement, $93 million. So currently, the local governments pay the normal cost for pension, which is the cost for the teachers working that year, their future retirement costs for that year of service. And the state pays any unfunded liability. So if the state has poor investment returns and we need to put more money into the pension system to make up for that, it's the state who pays that part of the teachers' retirement costs. The governor is proposing that the locals pay half of the increase in the unfunded liability, so about $93 million this year. And he makes them pay that $93 million on a permanent basis. It's not just for fiscal 26. It's every year they pay the normal cost plus the $93 million. So that's truly a cost shift to local governments, not to the school system. A couple of other things I'll note here. There's a 43.6 million item in the middle of the spending reductions, no retirement reinvestment. When you did retirement reform back in around 2010, you dedicated some of the savings to go back to the pension system to accelerate our return to an appropriate funded status. The governor is proposing to stop making that sort of extra payment, if you will. Total funds, it saves about $50 million. So those are some of the high points of budget reductions, or low points, depending on your view. Page 3 looks at the big picture. So, the major question for the state the last few years has been the structural budget outlook. And the blue dotted line there shows the Legislative Services forecast from back in December when we presented to spending affordability. And the orange bars is under the governor's proposal. What does the structural gap look like? And you can see the governor's made substantial progress throughout the forecast period in reducing the structural gap. The thing I would note is even doing that, and with somewhat controversial plan of cuts in revenues, there's still a significant gap when you get to fiscal 28 to 30. So this doesn't resolve the state's whole long-term budget outlook. It's sort of a first step, if you will, to resolving that longer-term challenge. The other thing I would note about this chart is there's no assumption about negative impacts of federal actions on Maryland. The revenue estimates that the Board of Revenue Estimates did back in December did not assume, cuts to the federal workforce that would impact the Maryland economy, and there's no assumption in the budget of significant cuts to federal dollars that flow to state government. So there is that risk that this outlook could get worse if there are significant cuts, depending on what the President and Congress ultimately do. Turning to page 4, back in December, when we were presenting to spending affordability, we thought there was a $3 billion cash deficit in 26 and about a 400 deficit in the current year, 400 million deficit. This just shows you how did that get resolved between the BRFA and other actions. About 40% is revenues, 40% is cuts, and about 20% is fund transfers. Page 5 shows you, well, where's the spending different than what we were forecasting in December? Where did it go down? Where did it go up? The biggest down part is the BRFA items, the $1 billion of cuts. But there's 3 policy areas that you may note seem to take significant cuts. One is childcare. The state's childcare subsidy program has been growing very rapidly. We had roughly 23,000 children in fiscal 23 enrolled in the program. There are more than 40,000 children enrolled in the program today. That significantly increased state expenses. We were projecting that that would grow to over 50,000 children in fiscal 26. And the governor is proposing to cap enrollment in the program at 42,000 for fiscal 26. So roughly 10,000 fewer children than might otherwise participate. Second area of cuts is public higher education for the 4-year institutions. In particular, the University System of Maryland in actual dollars is going to get about $106 million less in fiscal 26 than they did in fiscal 25. So they will have to make cuts to their spending and or raise tuition and fees to backfill. Third area is Developmental Disabilities Administration. The community services part of DDA has an enormous deficit in the current fiscal year. It's roughly $450 million. This is on a $1 billion budget, so it's a 40+% deficit. So the governor has funded that in the budget through a deficiency appropriation, but then he's proposing cost containment of $97 million in the current year and about $235 million in fiscal 26. And I think there'll be much discussion in Budget and Tax about those proposals. There's actually a hearing tomorrow on DDA. On the far right side, you see areas where we got more funding than we were projecting, the biggest being Medicaid. We think that is just differences in assumptions, but we are still investigating them. The Medicaid budget is very large and takes a while to absorb all of what they've done. There's also a significant amount of what I would call discretionary enhancements, which are outlined on page 6. Not going to go through this list. I would say about 2/3 of it is kind of economic stimulus related. Is one of the governor's concerns is the Maryland economy has been growing slowly, so he's trying to do some things to stimulate economic growth, especially in the private sector, given the concerns about possible, federal workforce cuts. Changing gears on page 7, we look at the income tax proposal. There's a couple of components to the tax proposal. The first is changing the income tax brackets. We've highlighted in yellow the brackets where there's a change. At the bottom of the tax brackets, there's a consolidation of having one rate for the first four, what currently are four brackets. It's worth noting, like if you look at the individual filer, for income between 3,000 and 100,000, there's actually a slight tax cut going from 4.75% to 4.7%. This is part of why the governor is saying that the budget plan for the majority of Marylanders will reduce their taxes. On the high end, though, you can see the significant increases in the tax rates, with two new brackets being created for the individual filer at the $500,000 and $1 million thresholds, slightly higher thresholds for the joint filers, so 6.25%, 6.5% rates there. In addition to those rate changes on capital gains income, the governor is proposing a 1% surcharge. That would apply to anyone whose taxable income is over $350,000, whether they're a single filer or a joint filer, and they would pay 1% on all of their capital gains income. So those are the kind of core changes in the brackets. The other major changes the governor is making are he's doubling the standard deduction. So for lower income people or people who just are already using the standard deduction, that will help reduce their taxes because they'll get a larger reduction in their taxable income. But he's also proposing eliminating the option to itemize on your taxes. This affects about 23% of Maryland filers back in 2023 were itemizers. For most of those people, that will likely result in more taxable income in Maryland, and they will pay more on that additional taxable income. And then if they're a higher income, they'll also be paying those higher tax rates. So those are the major income tax changes. The next page, page 8, provides a lot of detail on the revenues the governor is assuming from all of his different tax and fee changes. In total, they add up to $1.4 billion of tax and fee increases in fiscal 26 and pretty much similar levels in the subsequent years. And we've talked about the first few items on the page. About 6 items down, there's a change in corporate income tax. The governor is proposing to do combined reporting, which will generate some additional revenue for the state. At the same time, he's proposing to reduce the corporate income tax rate from 8.25% to 7.99%, phasing that down over a 2-year period. And you can see that reduces revenue from the corporate income tax a little bit. The other major change that I haven't talked about on taxes is death taxes. The governor, again, has a 2-pronged proposal there. He wants to eliminate the state's inheritance tax. But then to make sure that this plan is cost neutral, he lowers the estate tax exemption from $5 million to $2 million. So more households will pay the estate tax as a result. And the belief under the governor's scoring is that these two things are cost neutral so that the state will get the same level of overall revenue. Now, the green section of the numbers are the dollars going to the Transportation Trust Fund. They total up to $470 million in fiscal 26, $420 million in the subsequent years. The biggest change is a new retail delivery fee, which would be 75 cents per order. So just to be clear, so if you order from, say, Amazon, you can order 12 things and they can send it to you in 6 packages. You're just paying the 75 cents once. It doesn't matter how many actual packages or how many deliveries it is. You're paying per order. It only applies if the order has something taxable in it. So if you get it, like use a mail order pharmacy, your prescription drugs are not taxable. You wouldn't pay the 75 cents on that. Just as an example. Or if you just ordered purely groceries that are tax exempt, you wouldn't pay the 75 cents for that. So that proposal would raise about $225 million a year. The other major transportation revenue proposal is to limit the vehicle trade-in allowance to purchases of $15,000 or less. So there would be no trade-in allowance for anyone who's buying a new vehicle. It would only be for certain used vehicles. You can see they expect significant revenue from that change as well. So those are the major transportation revenues. The items in red are various special funds that will be getting some additional revenues, mainly through fee increases. Some of them we haven't been able to score yet. We're working, there's a lot of individual fees that need to be scored. So that's pretty much the revenue overlook I wanted to give you. Page 9 has some other key points in the budget, the biggest being related to K through 12 education. Budget grows by $550 million for local school systems, about a 6% increase. But there are some changes to the Blueprint Fund proposed that would provide short-term savings. One is to reduce the mandate for behavioral health services that go through the Consortium on Coordinated Community Supports. The mandate is $130 million. The governor is proposing making it $40 million, and that is a permanent change. You've heard, certainly in the media, this talk about classroom time and collaborative time for teachers. Under the Blueprint Fund, starting in fiscal 26, there was going to be additional funding provided to locals so the teachers could spend less time in the classroom, more time collaborating. The governor's proposing to suspend that change for 4 years, starting to phase it in 2030 instead of 2026. Saves $124 million in fiscal 26, over $500 million by fiscal 29. And that's savings to the Blueprint Fund. He's also proposing a change to the concentration of poverty program, fully funded in fiscal 26. In fiscal 27 and 28, he would pause the growth in the program and then would restart growth in fiscal 29. This would save by fiscal 28 almost $200 million. And there's some savings in the out years too, because he's kind of slowed the trajectory of that program. This is a program that sends money directly to public schools that have high percentages of their students in poverty. Those are the major cost containment. There's also some new Blueprint Fund spending on some new programs, including the Grow Your Own Educators grant program, which was enacted by the General Assembly last year. In the health area, there's a 1% provider rate increase for most providers. I've talked about the DDA cuts. On page 10, I'm just going to mention two things, and you can read through the bullets at your leisure. State employees get a raise this year, even despite the budget challenges. About $180 million in the budget from general funds for a 1% cost of living increase and for the regular employee increments or merit increases, if you will. The other thing I would note is the fourth bullet on that page looks at local aid. Overall, the governor is shifting $144 million of costs from the state to local governments. Some of that to the local school systems, a lot of it to the local governments themselves. And there's also some reductions in other local aid, but it's $144 million that truly is a cost shift to the locals. I'll wrap up on page 11, I think. What we hit here is some of the key issues for the session in terms of fiscal outlook. One is obviously the long-term budget outlook. Second, as I mentioned, is the concern about what impact the federal actions may have on the budget. And the third is this Child Victims Act that the General Assembly passed in 2023. It allows people to make claims against the state for sexual abuse that occurred when in state custody, going all the way back in time. So some of these claims go back to the 1960s. So far, about 3,500 people have come forward with claims. I think all but 2 of them relate to time in juvenile services facilities, again, going way back in time. The state's liability is capped in the statute at $890,000 per occurrence. We do not define what occurrence is. So defining exactly what the potential liability is a little bit challenging. Most of these claims have been consolidated under a few attorneys. They are negotiating with the state. The Attorney General's office has hired an outside counsel with a lot of expertise in these types of cases to help with that negotiation. There is some hope that there will be a settlement agreement reached before the end of session, in which case the Attorney General's office may come back and ask you to find the money to appropriate for that first year of settlement payments. We have no idea what that amount could be, but given the fairly staggering potential liability, it could be a significant settlement payment that would need to be funded in the budget. There's no money in the budget to make a settlement payment. There is no money sort of earmarked in reserve to make settlement payments. So it'll be, a challenge to find money if there in fact is an agreement before the end of session. Madam Chair, that's the highlights. I am more than happy to answer questions on anything that members have.
Senator Reedy.
Thank you, Madam Chair. where to begin. I know we can't ask 28 questions, but there are some important issues you brought up. And, this is not the budget committee, but so much of our budget is wrapped into healthcare and health policy. And so it's important that we know where money is. I want to start where you ended, because I think that's an interesting point. You mentioned 3,500 cases right now, potential settlement. News reports have said it could be in the neighborhood of $3 billion, but we don't know. $3 billion. But it's true that there's more than 3,500 cases, correct?
Yeah, these are just the people who've come forward so far. I mean, if you listen on the radio, there's constantly ads from the law firms, soliciting more clients.
My understanding is the 30, and I know I'm not putting you on the spot. My understanding is the 3,500 figure is ones that a law firm, this consortium of law firms has vetted. The Attorney General may not have fully vetted them yet, but there are thousands, potentially more. Now, some may be frivolous, some, but we're certainly staring down the barrel of many billions of dollars potentially. So that's something that I think casts a little bit of a pall over all of these discussions. But so there's nothing in the budget set aside for that at this time. Let me shift gears for a moment. You mentioned that there is still an employee raise this year, a 1% COLA. What were the raises the last 2 years? Do you know?
Yeah.
I know it's hard to pull everything offhand, but I feel like we've had raises the last 3 or 4 years in state government.
Yeah, I think you all have the full fiscal briefing document in front of you. If you do, it's page 31, shows the salary increases by year in recent years. And there have been steady increases. There was a really large increase in fiscal 23, in part to try to address sort of the difficulty state was having in filling positions at the time.
Oh, yeah, for sure.
Which we still frankly are. I mean, still 10% of state positions are vacant. But you can see there's been steady salary increases for a number of years.
On that point, were there any savings, and if I missed it, I apologize, were there any savings on just retiring or getting rid of vacant positions? Or has the governor put anything in his budget retiring anymore? I know you need some vacant positions, obviously, but.
Right. No, I mean, the budget actually adds state positions, doesn't
Really?
cut them. There's about 1,000 additional positions in the state budget. But almost 400 are contractual conversions. So people who've been working as contractuals for multiple years. So it's not all.
It's not all new money.
bodies.
I understood.
But
Okay,
there's still probably a net 600 new positions. So there's no significant position cuts in the budget.
But now they can enjoy all the benefits that we give to state employees instead of just being contractual, which also costs money. And then the last question I have, I could ask several more. This is fascinating stuff on the income tax, because we've heard from the governor, 2/3 of Marylanders will see their income taxes go down, which sounds exciting. But it looks to me like if you factor in, I wonder if you could explain to me, number one, the rates go up in this chart for any income under $4,000, but most people obviously don't have just income under $4,000, so that rate, does that little amount net the state any money?
I guess it would, 4.7% instead of 2% on $1,000 generates, a very small amount of money. Yeah.
But the itemization, I'm glad you brought up itemization, because that kind of flew under the radar. But most people I know at least consider itemizing, because they own a house. If they own a house, they may give charitably. There's other itemization. So that affects, you said, up to 23% of taxpayers?
Yeah, about 23% of Marylanders have been itemizing in recent years.
So it's also fair to say those are not just the so-called high earners that will get the tax increase, but this is a lot of middle-class families would see an increase because they can't itemize anymore.
I mean, 20% of the taxpayers, so yeah, it's not going to just be the small group at the top.
Okay, all right. And I love, and then closing, Madam Chair, you have a really great chart in here on page 4. I would encourage, when we hear that we have $2 billion in cuts and $1 billion in revenues, the chart here indicates is not a 2-to-1 cuts to revenues split in how this budget's actually being balanced. So I appreciate your excellent presentation. I look forward to reading more of this book. Thank you.
Thank you, Senator. And Senator Guile?
Thank you, Madam Chair. David, the delivery fee or the 75 cents, is that applicable to DoorDash? Do you know? I'm just curious.
I think it would be if they're bringing you, if you get food from somewhere, the food's going to be taxable if you're getting it from a restaurant.
From a restaurant.
So yeah, so I believe it would be.
But if they're delivering something like a grocery order, obviously, then that would be different. Then that item wouldn't be taxed since it's
I believe
food.
that's correct. As long as the grocery items are the non-tax, because, you can buy things at a grocery store that are taxable. So
Right.
You have to have a purely non-taxable set of things you ordered.
Okay. And just one quick question back to the Child Victims Act claims. I mean, to be clear, so there's the, and I think Senator Reedy was saying this, so there's 3,500 claims right now, but there's nothing to preclude future claims, obviously, since we've lifted the statute of limitations. And certainly, I mean, these are just the combined cases right now, and there's a settlement agreement. There's nothing to preclude future claims if somebody decides to file some claim in the future, correct?
That's correct.
Okay. All right. Thank you very much, David. Thank you, Madam Chair.
I'd like to ask a question on the 75 cents on delivery. Will that go into the transportation fund? Is that totally dedicated to transportation fund?
It is.
Thank you. Senator Hershey, you're next.
Thank you, Madam Chair. And David, if I could follow up on that too. On that line item, you have an asterisk there. It says requires legislation. Is that something separate from the BRFA? Or
No.
could the BRFA be the vehicle that is the legislation that's required?
All of the taxes and fees that I have in that chart that have asterisks, they're all in the Budget Reconciliation and Financing Act.
Okay, so that will be covered in there. Okay, thank you. Senator Reedy got a number of my questions, but I am interested in the structural outlook on page 3, where you state that some of the changes made in the governor's budget, especially in the out years, took essentially $5 billion, $5.3 billion, and $6 billion structural deficits and lessened them to some extent, but that's assuming a number of things take place, right? Combined reporting is one of those that are.
Yes, it assumes this entire plan that I've walked you through the highlights of is enacted as proposed.
Okay, so in a sense, we could be in the 2028 budget almost in the same predicament that we're in now, a $2 billion deficit still. And is a lot more of that related to the funding of the blueprint as that starts to be moved out a little bit?
Yes, so I would say about $700 million of the structural deficit in each of those out years is not related to Blueprint.
That's it, 700 million.
$700 million a year is kind of other, healthcare, all the other things the state is paying for with the general fund. And the rest is the Blueprint.
Okay. Not going into some of these numbers, $700 million is an easy fix.
The state has been able to resolve that kind of deficit in the past.
Okay. Real quick, another one. The transfer to the general funds from CEF, $150 million. That's basically the energy tax that all residents pay in Maryland to get clean energy. Do you know what the balance remaining will be if you shift $150 million of there?
There's still a fairly significant balance. The governor uses the CEF funds in a variety of ways that require legislation. Let me see. I think I have this. Oh, should make this. The closing balance in CEF for fiscal 26 is $339 million.
So you took about half, right? That's before the $150 million transfer.
No, it's after.
So there'll still be $300 million. So there's $450 million.
$339 million left. Yeah. So.
A lot of money. You also mentioned what's interesting, this conversation and concerns about federal actions, things getting worse. Safe to say that the counties in Maryland are kind of feeling the same concern about state actions as they look through this budget and see all of the costs that are being shifted down to them because the state's trying to fix its fiscal woes?
Yeah, so it's interesting that, like I said, there's $144 million true
Right.
cost shift to the counties. We have not scored the administration's tax plan. We're showing you their numbers. I am told that the administration is scoring the tax plan as generating about $100 million a year for local governments. So there will be some, lack of a better term, windfall to the local governments from the state changes to itemization and so forth.
So that goes back to the governor's statement that, well, he says 82% of Marylanders will pay less or the same. It's comparable to saying 18% of Marylanders will pay more taxes. And so what you're saying is because of these tax changes, the counties will see some type of windfall in additional income tax,
Right, their income tax revenues will go up some as well.
they'll go up as well. When we just, and I was wondering if you know this, again, I think Senator Reedy mentioned, if you really take a look at the tax brackets, there's 10 of them now. 1 is lowered and 5 are increased
Yeah.
of all of those. So it's obviously only 1 being lowered is pretty, but of those, when we get to the 6.5% and the 6.25%, those are the ones that you've seen the real increase. Do you know how they compare to other states around us or anything like that? I think.
We can get you that. I don't have it with
Okay,
me.
if you don't, that, I understand that. And then, again, with the itemized deductions, he talks about doubling the standard deduction, but then eliminating itemized deductions. And outside of running, I mean, this could also affect a number of small businesses as well, too, that use their personal income they use their business as a pass-through entity on their personal
Right,
returns.
right.
So if a small business, which a lot of them do it this way, generates a taxable income over $500,000, this in a sense raises taxes on all small businesses that are over that amount, right?
That's correct.
Okay. And the small businesses, I know the federal form is, I think, a Schedule C, but when you bring that over to Maryland, you would be able to do you know how that will work with small, I mean, if they can't use, itemized deductions are just personal, correct? Is that right?
I'll have a tax person get back to you.
Okay.
I don't want to give you the wrong
All right,
information.
and then let me just go to itemized deductions once more, because I think two of the biggest things that people see in itemized deductions are mortgage interest and property tax, or can be itemized, right?
And believe Maryland's largest itemization is actually charitable donations. Yeah.
It's charitable?
Yeah.
Okay.
But you're right, the others are significant as well, as
Okay.
you mentioned.
If we're trying, okay, that might be a different story. If we're trying to promote housing and home ownership, this doesn't seem to be something that is positive towards owning a house if one cannot deduct their interest or property tax any longer. It might be more of a policy issue.
I'll leave that to you.
Yeah, I'll make my own narrative on that, I'm sure, at some point in time. Just last thing, if I could ask, because it's gotten a lot of conversation, the child care subsidies. What are the overall program costs for that? Do we know annual program costs?
I want to say it's in the 300 million range.
300 million, and the governor wants to cap that at 42,000 children.
For fiscal 26, yes.
So I'm sure there's some kind of a cost per child that an
Yes.
easy division that I could do to see what it costs per child to do on this program. 300.
Yeah, we can get you that.
Yeah. Okay, I can figure that out. Thank you very much.
Sure.
Appreciate it.
Madam Chair, I just want to, it's actually on the screen, but I'll just call attention. Page 13, I think it is, yes, page 13 of the document you have. We did score what the tax plan does to various households. And we just took 6 sample households, so it's not, and all of them assume they have dependent children, so it's not a perfect analysis of all scenarios. But it shows you, it gives you a flavor for, how some households will see a tax cut and others will see a very substantial tax increase. But I'll just call your attention to it. Page 13.
Okay. Vice Chair?
Thank you, Madam Chair. Thank you, David. David, somehow I missed, you were talking about the settlement that's to be expected by the end of this session. What was that?
It's the Child Victims Act. So these were people who were abused when in a state facility, state custody. Again, there's no statute of limitations, so some of these cases go way, way back in time.
Got it. Yes, I've heard the commercials as well. Additional 600. And then the reduction in the behavioral health, those are the grants that the Community Health Resource Commission give out to various providers throughout the state.
The consortium money, yes, it goes out for behavioral health, yes,
Got you.
through that commission.
And then you mentioned something in here about the pause on the concentration of poverty program. Is that what we often refer to as community schools?
It is, yes.
Yeah. And lastly, the 75-cent delivery fee, what is that estimated to generate?
I think it's 220, let's make sure I get the right, 225 million.
Okay.
I should have noted before, it's also just worth knowing, it's indexed to inflation in the proposal, so that in future years, it might be a little bit higher than 75 cents.
Gotcha. Okay. Thank you. Thank you, Madam Chair.
Thank you, Vice Chair. Senator Ellis?
Thank you, Madam Chair. Appreciate you. Thank you again, Mr. Romans. I have a few questions. Some of them are just basic, like trade-in allowance for vehicles, limiting that to 14,000 and change. What does that affect? Does that affect the taxes we collect? I can't see the connections to someone trading their vehicles in the state budget.
If you get credit against the trade, they apply the trade-in value of a car under current law against your purchase. So it reduces the amount of the purchase that is taxable, because you don't have to pay on the value of the trade-in. You don't have to pay the tax.
Yeah, do you have any data on the average trade-in allowance now?
I don't know. The Department of Transportation has said that 40% of purchases are for vehicles $15,000 or less. I think there's been some pushback from the industry, so I'm not going to say that, we haven't had a chance to delve into all of that. But so, it depends on the vehicle. Each person's experience will be different.
So do the governor's folks, do they project what dollar amount will come in because of this change?
They're projecting revenues of $140 million to the Transportation Trust Fund from this change.
So that'll be a $140 million hit. Okay, yeah, so they have the numbers.
Yes.
Like I can get the numbers from them.
Yes.
Okay, great, thank you for that. And community schools, and Vice Chair asked a question about the numbers. And so what are the community schools that will be affected by their reduction in funds? What are they?
So to qualify for the program, you have to have a certain percentage of the students in that school, it's school specific, living in poverty. I can't remember if it's like 55, 60% of students have to be in poverty to be in the program.
Yeah.
And under current law, once the school qualifies for the program, they get a slowly increasing amount of funding per pupil until it's fully phased in after, I think it's 7 years. So there are many schools, we've only been doing this for a few years, so most schools have not gotten to the maximum per pupil amount that they would get. So they're in the middle of the phase-in. So the governor is pausing that phase-in. So then instead of continuing to get a little bit more money for each student in subsequent years, they'll be at the same level that they are in fiscal 26.
Which means that they will continue to get additional funding, but it's just not phased up.
Right, so let's say as a result of the program, right now your school is getting, I'm just going to make up a number, $500,000 in fiscal 26. You'll keep getting the $500,000 in fiscal 27. So you still get this program keeps giving you funding, but you wouldn't get the $530,000 or $540,000.
Okay, so they will keep that additional monies which they're getting now.
It won't grow. It won't grow as they were expecting it to.
So it's not a total abdication and say forgetting our poorest schools, but they will keep getting some additional funds.
That's correct.
Okay. Oh, thank you for that explanation. So the itemized deductions also, that change, of course, it will affect people who have a greater amount of things to itemize. So mortgage and other charitable deductions, right? That will affect that.
Yep.
And what are some other things that goes in itemized deductions that would be kind of phased out for high-income folks?
But property taxes.
Property tax, that's one, okay. So property tax, mortgage interest.
Mortgage and charitable are the big ones. There's also,
one?
some
What's the
people
last
can
one?
deduct some medical expenses, but that's not as big of a, in the grand scheme of things, that's not as big a dollar amount.
So charitable, okay. And so what jurisdictions would be affected the most from this? I mean, I hear some numbers, some people crunch some numbers and say the highest itemized counties are, do you remember those?
Yeah, I can, it's surprising. We've looked at the itemization by county, and it's not necessarily quite what you'd expect. So like Charles County is one of the highest itemizing counties in the state, higher than Montgomery County at like 33%, I want to say, versus Montgomery County is 26%. Prince George's is 30%. So it's not quite, it doesn't go quite as, if you just think about the wealth of counties, it doesn't quite follow that trajectory.
So why is that? If it's not based on the wealth of the county, why would, say,
You know, I
Charles
think
County
we're
have
still
so much
looking into
itemized?
that. I mean, you know, there may be more charitable giving in certain counties for whatever reason than others, so people are claiming the deduction. There may be
thank you.
more middle-income people in certain counties who claim the deduction.
So no matter what the reason is, folks in my county will be hit the hardest by that change.
Yeah, it's one of the highest percentages of
Yeah.
people who would be
Okay.
affected.
So I should be fighting the hardest against that change, right?
I can't speak to your decision, your personal decision.
And I definitely will, because, we shouldn't have that kind of hit. But I have to understand the issue before I can really articulate it, so just say no. Well, okay, well, thank you so much for your questions, for your answers. I appreciate that. Thank you, Madam Chair.
Thank you, Senator Ellis. Senator Kramer, you're next.
Thank you, Madam Chair. David, thank you very much. Couple of quick questions. Would you refresh my memory, please, about the local income tax reserve fund? I
I'll do my
believe
best.
this has been a subject of some discussion in the past.
Yes, so as you all know, the state is the one that collects the income tax, both for the state share of the taxes and the local income tax. So then there's a holding account, which is the local income tax reserve account, where they put the locals' money into that account, and they distribute it like 5 times a year. They make distributions to the county, so everybody gets their appropriate funding level. But there's always sort of a float in that number, so there's always a balance of cash in that account from period to period, and that balance is quite significant in terms of total dollars. So what the state is proposing in this case, or the governor's proposing in this case, is to borrow from that fund, because they always have a surplus, to borrow some money with a payback provision over 10 years starting in fiscal 29. So it should not, because it's a small amount relative to the balance in the account, it should not in any way impair each county from getting its fair share of the money in each distribution. But from an accounting standpoint, we wouldn't have quite the right amount in the account.
And why is there that there's a significant balance in getting these funds back to the local jurisdictions? Can you explain?
I will give you a written explanation, as it gets into the accountant's world, which is not my world. So I will get you an explanation for that.
Okay, thank you. The reduced state share of K through 12 teacher retirement, do I recall that as of maybe 15 years ago or so, that was entirely a state responsibility, and then that got pushed down the hill to the local governments? Do I recall that correctly?
That is correct.
It is. And so now, having once already pushed that down onto locals, we're sort of piling on again by reducing what the state does contribute to those
Yeah, the state is
retirement
yes.
costs.
Yeah, the state is reducing the share of those costs that it's paying. Yeah.
Okay. And is that part of the 140 million
It is.
that
correct.
the locals are taking the hit on?
Yeah, and I'll just call for those of you, since you have the document with you, I think it's page 60 for all of your interest, shows you that 144 million shift by county. So
Oh,
you can see
good.
what
That's
your
just what I was
counties-
going to ask you for.
So Montgomery
that's-
County would pick up almost 28 million across all the different changes.
Okay, got it. Okay, thank you. No, that was going to be my next question, is if you had that breakout, so good. And that's the full 144 million.
Exactly.
Okay. Does it break it out by teacher retirement also?
Yes,
in
it
that?
does. There's 4 categories of costs being shifted, and it shows you each
Each of
bucket.
them.
Yeah.
Thank you. So quickly following up on a couple of questions that Senator Hershey had. Do we know how many pass-through entities, subchapter S, corporations there are in the state so that we do have some idea of what the implications are on those pass-through entities that are going to perhaps fall into the category of now higher tax rates? Is that a statistic maybe you could get from the comptroller?
Yeah, we can inquire of the comptroller's office. My next meeting is a talk with the comptroller's office about various data we want, so I can inquire about that.
Would you please? I think that's an important figure for us to have as we're looking at the business climate here in Maryland and our competing jurisdictions. Would it be possible, and I think Senator Hershey may have asked that, to get the, I guess, the tax rates of our neighboring states, perhaps North Carolina, Virginia, Delaware, and Pennsylvania, which is where I think we are frequently looking to do our best to compete, so that we might have some idea as to where we are in that. And I could be mistaken, but I did have someone who has a sort of pretty good handle on this that indicated by the time you take a look at all the different pieces of this, we may be as high or potentially higher than California with regard to tax rates and the implications for, I guess, the higher wage earners.
I'm certain we have the rates for the other states, so we can definitely start there and see what else we have.
Yeah, it would be very helpful because I think this issue of how competitive we are. Now, I also recall, and I don't know how much was fact or fiction, our former comptroller had indicated at one point in time that we were, I think, hemorrhaging high wage earners in the state. Is there some way to get information, maybe again, you're meeting with the comptroller's office, breakouts by certain tax brackets over the past, I don't know, 15 years as to those percentages of high wage earners that may have left the state? Is there, I recall the comptroller, the prior comptroller one time having those kinds of numbers.
Yeah, we can see what's available. It's a little tricky because, many of the high earners have a lot of capital gains revenue from you, and that obviously fluctuates. That depends on your personal decisions about when you sell assets and so forth. So people can, like the number of high earners may drop, but it may be because it was a bad stock market year or so forth. But I can see whether we have any data about actually leaving the state and not filing in the following year.
Yeah, I'd just be curious to see if that was still an issue. And that just brought me into your comment just there, leads into this next question. With this surcharge on capital gains, are we, and I guess it would be speculation on your part, would that maybe cause certain interest to defer sales of assets for during that period of 4 years that perhaps they might not, or perhaps encourage 1031-like kind exchanges where otherwise people may have said, fine, I'll eat the capital gains, but maybe now they'll be looking, I can't afford to do that, so that maybe ultimately we're not going to see the revenue increase that might be projected just as a consequence of a change of behavior, accounting behavior.
Yeah, I am not one of those high earners, so I hesitate to speculate on what decisions drive all of their individual decision making. Obviously there'd be some people who would probably take into consideration the things you're suggesting, but I can't really speak. I think it depends on people's individual circumstances.
Mm-hmm. Okay, thank you. The corporate income tax reduction, we are going from what to what?
8.25% under current law to 7.99%. And that's phased down over 2 years in equal tranches. So it goes down to 8.12 and then to 7.99.
Would we be able to get some information on where Virginia is on their corporate income tax rate and what that looks like? Combined reporting, am I correct that Virginia, Delaware, and Pennsylvania are all non-combined reporting states?
That I don't know off the top of my head.
Would you maybe be able
Yep,
to
sure, we can certainly
please?
get you that.
That would be great. I think it would be helpful to know that. I think, Madam Chair, that's my question. So, David, thank you again very much for the briefing. Appreciate that. Thank you, Madam Chair.
Senator Kramer, thank you for your questions. Senator Washington.
Thank you, Madam Chair. Just questions on Blueprint for me. For the community schools aspect of this budget proposal, is the pausing of the growth and concentration of poverty program for 2 years, beginning with fiscal year 2027, is that the only thing relative to community schools that's in this bill, that's in this proposal in reduction, or is there others?
No, that's the only change.
Okay. And so what's the savings on that?
The first year is, I want to say it's about 60. Let me just check my notes here. Get this right. The first year is about 70 million in fiscal 27 of savings and 193 million in fiscal 28. And there are some residual savings in subsequent years because then you sort of restart the funding increases back where you would have been in 26.
Yes. And so does this mean that if we agree with this, one, does that mean that those students in those classrooms, whether they increase in the number of students in poverty, they're still halted at that, just to use an example, $500,000 in concentration of poverty grant, they will be halted that although they can grow significantly 10% or so every year throughout that time, but no new increase in dollars to take care of those students.
So the bill just came in. Now, so there's some, we're doing some trying to interpret what the bill means exactly.
Who sponsored that bill?
But my understanding is that, so if you're a concentration of poverty school and you have 70% of your students are in poverty, so you get a grant in fiscal 26 that is 37% of the per pupil amount. So for each of your students, you get 37% of what the concentration of poverty per pupil amount. In fiscal 27, you're supposed to go from the 37% to 55%, and then 28 to 66%. So he's pausing it at 37%. You wouldn't get the growth for those 2 years, if that makes sense.
Right. No, I get that. But my point is that although my concentration of poverty levels might increase over a certain period of time, I'm only getting that 37%.
Right.
That's right, right? And you said 70 million and 193 million
Yes.
for 27 and
Correct.
28.
Yes, sir.
Does the bill authorize it to then automatically resume, or do we have to pass legislation to resume?
No, the bill resumes it starting at fiscal 29.
And will it go back, will it then, 29 will go to the 70 million initially?
29, you'll get what you should have gotten in 27. The percentage should have
And then,
gotten in 27.
therefore,
so it's like
after-
a 2-year pause, and then it starts phasing back up from that.
Got it. Okay. And, okay, got it. And that's just the state's, because the concentration of poverty grants only come from the state. Is that right? The funding
I
for
believe
it?
that's correct, yes.
Is there any way for the locals to have their own? Because, I mean, we put a lot of weight on the locals to provide funding for these schools as well. Is there in that bill, is there anything in there that states that the locals will have to pause it as well, or pause any funding that they have that goes to the concentration of poverty or community schools?
I mean, there's nothing that like prohibits locals. Locals can make their own choices in terms of, putting additional funding in.
Got it, okay. Yeah, that's, to me, that's concerning, obviously, because I worked on a blueprint for 4 years and then sponsored it in the House and want to continue. I mean, this is the most important piece, in my opinion, because it does drive down the poverty rate in Prince George's County. We have the most in the state of community schools, where we're at 1 and 2. We're Baltimore City, and so that's pretty significant in funding that's going directly to some of these schools. So I would hate to see that bill passed. That's my point. Thank you, Madam Chair.
Thank you, Senator. And Senator Lamb?
Thank you, Madam Chair. Just wanted to follow up on Senator Washington's point on this. So you're saying that the community schools dollars or the concentration of poverty grants are paused until FY29? Is that right?
They're fully funded under statute in fiscal 26. There's no change to 26 statutes. For 27 and 28, they're paused, and then they start up. Then
Pauses and there's no increase, but they will
Exactly,
continue to be
exactly.
funded until FY28, you said?
in 29.
29.
So 2-year pause. 27 and 28 are the pause years, then you start growing again in 29.
But I guess just looking at this chart that you happen to have up here, it runs out of money in 28.
The Blueprint Fund will not have enough dollars to pay all of the Blueprint implementation costs starting in fiscal 28 under the governor. That's just under the governor's proposal.
Right.
So just general fund would need to supplement the Blueprint Fund to fully implement, the Blueprint program in fiscal years 28, 29, and 30. And that is a significant portion of that structural budget challenge I talked about earlier, is the contribution that the Blueprint fund not being able to cover all the costs makes.
So basically, FY28, if we wanted to support the increase in these funds, it would have to come out of the general fund, can't come out of the Blueprint
Exactly.
fund. And then in subsequent years, even though he's lifting the pause on the community schools grant, there's no money.
Under the governor's proposal, the Blueprint Fund does not support all of the Blueprint costs in the out years, which was true before the governor's proposal too. So one way, so the state is, if the state wants to fully implement Blueprint as it is, it either needs to put general funds in, which is what we're showing in that graphic on the chart, or it needs to identify additional revenues that go to the Blueprint Fund so that the Blueprint Special Fund can fully support those costs.
So I guess one option is we get to, 2028, I guess, or
Yep.
so, and they could decide to extend the pause on the community schools grant, right, to help address some of the.
They could, or
Budget
there's
challenges.
certainly there's other ways to reduce Blueprint costs. It doesn't have to be community schools, but
Right. About one of the other things that we've heard as a significant cost driver is Medicaid spend. Is that shown here and anywhere in some of these tables or charts, or what is the actual increase in Medicaid spend?
yeah, so it's way back in the end. There's an appendix on Medicaid. Appendix page 72, if you want to look at that, shows the Medicaid budget. And total funds, it's growing about 154 million or 1% in fiscal 26. General funds by about 140 million.
Got it. And then on page 73, I guess, is showing the actual increase in Medicaid expenditure growth.
Yeah, the drivers. I mean, one of the things that's keeping costs down is enrollment is dropping a little bit. And that's because during the early part of the pandemic, when we got an enhanced federal match for
the
Medicaid,
redeterminations.
we couldn't disenroll people.
Right.
So the enrollment grew quite a bit. So then last year, we had to do, under federal law, had to do the regular disenrollment process. However, Maryland got a lot of federal waivers to avoid pushing various groups of people off. Many of those waivers were one-time, one-year solutions. So now we're starting to see more people drop off as because they were only able to stay on because of these temporary waivers that we.
Oh, so the waivers were only 1 year, and they gave
Many
us
of
like
them
a
were only 1 year, so-
1 year reprieve, and now they're coming back.
Exactly.
I see. Okay. You also mentioned earlier that there is a increase in the assessment on the Medicaid hospital assessment, right?
Yes, sir.
So the governor is proposing, is it a $50 million increase on hospitals this year?
In the current year, yes.
And then is it another 100 million in the subsequent year, the next fiscal year? Or
Yes,
what's
so
the
it goes
proposal?
50, and then it goes another 50 to get you to the 100.
To the 100?
Yeah.
Okay. And this was an assessment that I think was started probably under the O'Malley administration. And my understanding was that I think it was supposed to be temporary. It was never lifted, and it's here, and now it continues on. Now it's actually being increased. The hospital tax is being increased.
Yeah, so you're right. It was originally proposed during the O'Malley administration, and it went up for a couple of times during the Great Recession. A few years ago, the General Assembly brought it down a little bit. And this is taking it back to kind of the high point of about 400 million a year.
Okay. Is it possible, and you may need to look into this, to get a full understanding of the assessments, taxes on hospitals, like over the next 2 or 3 fiscal years projected out? Is this the only thing, or are there other?
This is the only special assessment on hospitals. It'll be 394 million each of forever from now, is under the governor's proposal. It'll be 394 million in fiscal 26 and each subsequent year.
394 million every year, continuing on.
Exactly.
Once this increase is fully implemented.
Yeah, once we get the
right?
increase up to 394, it would stay there permanently.
Right. Okay. Is there anything else that's impacting hospitals?
Not that we're aware of. Like I think I said earlier, the Medicaid budget is very complex, and we're still working through all the little nuances to see what else is going on, but we don't believe there's anything else hospital-related.
Okay. All right. Thank you.
Thank you, Senator. I have a question along your line. You know, we talked earlier this week with Senate Bill 229 about the assessment that funds the HSCRC. Is that in addition to this assessment, or
That
is
is a
that?
separate assessment, yes.
It's a separate assessment?
Yes.
So that's more money for the hospitals? Yeah. Thank you. Senator Washington?
Thank you, Madam Chair. I'm taking the second bite of the apple because I was so enthralled about the community schools stuff, but and forgot my other questions that I had. There were some questions about the child care program. Can you just describe that for me again, just so I'm clear what I think there's a pause on it. Can you just explain that for us?
Sure. So the child care program has been growing rapidly in recent years, from 23,000 back in 23 to well over 40,000 today. The projections were it would grow to more than 50,000 children being served in fiscal 26. The governor is proposing to pause or to cap enrollment at 42,000 children for fiscal 26.
And what's the number we're at right now?
I don't have the precise number with me, but we're in the 40s. It's in the 40-something thousand. I suspect it's close to 42,000 would be mine.
Well, I hope it's not over 42,000.
Yes, I will check that. But
that would be bad, right?
Yeah.
And before we had 23,000, obviously, like a few years ago, we expanded the tax credit so that we expanded the program so more families can take advantage of it. In my opinion, it's a good thing that families are taking advantage of it because childcare costs a lot of money, and this program helps a lot of it helps a lot of disadvantaged families that can't afford childcare every day and still have to go to work every day. How much would this save the state in pausing it at 42,000?
I think my preliminary estimate looking at it is about $60 million.
Okay. All right, 60 million, potentially between the 42, and you thought about your assessment was that it could be projected to being 50,000 students in 26.
Yes.
From 42 to about 42 to 50, right?
Yeah. Exactly.
I think it's a good thing that this is happening, that families take advantage of this. We should help parents that need childcare. And can you talk about, I saw that, one of the senator across from me mentioned earlier about the tax, the corporate income tax going from 8.25% down to 7.2. Is that what you said earlier?
7.99.
7.99. Got it. Okay. What in this budget that of the proposal similar to this one was changed for working class Marylanders, someone earning between 50,000 to 150,000 a year, potentially. Just, are there any tax incentives or breaks for those folks that are included in here, similar to this corporate income tax?
I would say there's a couple of ways that they benefit. If you look at that page 7, the text, the chart on the
I'm on
screen.
that page, actually, perfect.
Yeah, so if you're let's just look at the joint households there. For people with income from $3,000 to $150,000, they're getting a very small percentage decrease in their tax rate from 4.75 to 4.70. So that will save them a little bit of money because they're paying a lower tax rate. The other way that many the families in the group you're talking about will benefit is that the government, many of those are people who use the standard deduction currently, and the governor is doubling the standard deduction, which will reduce their Maryland taxable income. So again, they will pay less in income taxes as a result of that. So there's a couple of
Is that the first feature, increasing the maximum standard deduction?
Yes,
from
exactly.
5,600 to 11,000?
Exactly.
Okay.
The other thing that it's really
And potentially, I mean, what does that look like in layman's terms? How can I tell a family this is how much money they can potentially save based on if I agree with this?
Yeah, so if we look at page 13, we did some sample families, and these are families with children in all cases.
Okay.
So you can see those households, I guess 1, 2, and 3 would fall into kind of the group you're interested in.
Okay.
And you can see that our scoring between the tax rate changes and the standard deduction going up is that all 3 of those families would see, a modest tax reduction on their state income taxes. So household 3 would see a $248 reduction in their state income taxes, and depending on what county they live in, a $126 to $179 reduction in their local income tax. So there are benefits to, families of modest means in the proposal.
But, okay. Got it. And so that's, for household number 3, that family would save $248
$248
that year.
on their state taxes and $100 or more, $100 plus on their local income taxes.
And a family of 4, just so I'm reading this correctly, would save $331, the one right under it.
Yes, exactly.
And the other families don't change? Is that what that's what I'm saying? It stays the same?
No, so we just chose, these are just 6 examples.
enough,
Obviously,
okay.
there's lots of scenarios you can
okay.
run. You can see the higher income folks who are in that higher brackets and are people who itemize are going to end up paying quite a bit more, $3,866 more for household 5, nearly $10,000 more for household 6.
Is FAGI federal adjusted?
Gross income.
I was close, man.
Yes,
That's what I'm
you
talking
got
about. Okay, cool.
But just one other thing I wanted to answer your question is that it's for really low-income families, but the governor is also changing the child tax credit. The child tax credit is only for families with children where the household has income of $15,000 or less. Right now, they qualify for a $500 credit for each child under the age of 6 and for each disabled child between 6 and up to the age of 17. The governor is concerned with the existing program is if your income goes up $1 to $15,001, you lose the entire credit amount.
Right.
So he's phasing it out so that you would continue to get some credit until your income hits $25,000.
Makes sense. Okay. And so these are for the ones that you just showed me, these are for very low income earners, child tax credit, this program you just showed me. What about for folks earning a little bit more than that, or middle income earners? Are there any tax deductions in this proposal for them?
Well, again, everyone's going to pay less on that income between $3,000 and $100,000
Yeah,
or
right.
so. So that's going to affect all of us it gets complicated depending on what your income is and whether you itemize or standard deduct in terms of what the other impacts would be.
The example you gave me for the household number 3 was they save $248 a year.
Yes.
For the corporate income tax, how much is there a similar chart for how much these corporations would save based on this reduction?
Not for an individual company. I mean, overall, it saves them like $33 million.
For the entire state or just for?
The entire state collectively, the corporate income tax cut saves 33 million the first year, and then when it's fully phased in, it's 69 million.
It's just 30, so, okay, got it. Fair enough. Okay, thank you very much.
Well, Senator Reedy was next, but are you take?
Quick follow-up on the child.
Okay. Do you mind, Senator Reedy? Okay. Go ahead, Senator Hershey.
Thank you, Madam Chair. I want to make sure, David, I understand the child care, because there is a reduction of, what is it,
Yeah.
196 million.
Yes, I thought you were going to ask me that. So
Yeah.
there's other things going on in childcare besides the enrollment freeze. Some of it is, I think, we just had different assumptions in the administration about quite what the average grant level would be and participation. But the other substantive change that the governor is making, a little bit complicated, is every 3 or 4 years, federal law and state law both require that we do a new market study to look at what the cost of childcare at childcare centers and family daycare homes is. And we're supposed to adjust our reimbursement rates to reflect those new, the updated market rates. So Maryland has done the new market rate study, and not surprisingly, childcare costs have gone up quite a bit since we last did the study. Right now, under current practice, we are reimbursing at a level that's 70% of the market rate. So essentially 70% of childcare providers, the rate that the childcare subsidy is enough to meet the charges from 70% of the childcare providers out there. The administration has to update under federal law for the new market rates. They don't think it's affordable to continue to be at the 70% level, so they're going to pay 50% of the market rate. So that means the subsidy will fully cover the charges from about half of the childcare businesses in the state. If you happen to be sending your child to a facility that the charges are more than that, that would fall to the individual family to make up the difference between the subsidy amount and the actual charges that that particular provider charges. So there's savings from, kind of not paying, continuing to pay at the 70% of market rate.
Okay, that's interesting. So from the parent's perspective, they will get less of a reimbursement. They were getting 70-cent reimbursement, will go down to 50%? Is that, or
So
however it
I
works?
suspect the actual reimbursement amount doesn't go down. I haven't seen the actual numbers, but I don't think the reimbursement amount goes down. But what we're saying is childcare costs in the state are much higher now.
Right.
So we should be raising it, and we're not raising it.
We're actually lowering it. And he's also capping the amount, the number of children that can participate in it as well.
Yeah. And it's been, we don't have details, but the administration is saying the cap will be applied in such a way as to, it'll mainly impact the higher income people who are eligible for the program. They're going to try to make sure the lowest income people can get childcare.
Okay. Is the fund staying at 300 million? It's just being dispersed differently under the new percentages?
I believe the budget grows a little bit, but it's just, it's being dispersed a little differently.
Okay. Thank you for the clarification. Appreciate it. Thank you, Madam
Well,
Chair.
that was a very quick question, Senator Hershey. Senator Reedy, I think you're going to have the last question. Thank you.
Thank you, Madam Chair, and thank you for this presentation. We appreciate that you come and give us answers because it cuts through a lot of, things that get put out there on all sides. Not to give you whiplash, but I hit my button after you were talking about Medicaid. So we'll just go back to Medicaid for a minute. And more of a broader question, and if you don't have this answer, feel free to, we could get it later. My understanding is that, number one, we expanded access to Medicaid back in the Great Recession.
Yes.
Are we still getting the same federal match that at one point that was like a 90-10 federal match, but now it's come down? Where did we end up there?
I believe actually, so it was actually higher for a couple of years. It was higher than the 90-10.
Oh, it was even
It's
higher.
now come down to the 90-10.
Oh, it's still 90-10 though?
Yes.
Okay, all right. So it's still not costing the state a lot of money to have that expanded Medicaid.
Right.
Okay, the state side.
On the state side, yes.
My understanding is also people have said we have a very generous Medicaid package as far as what's covered. And if you can't comment on this, is fine, or if you don't know. Is there a way for us to adjust some of what we do in Medicaid to save funds? And that's a controversial question, but I think considering the dire circumstances we're in, where we're talking about some of the things we're talking about, and with this looming lawsuit issue, I mean, I think we have to get more creative, in my opinion. I mean, is there, in your view, it's a policy question. I'm not asking you to endorse a policy. I'm just saying, is it possible to make adjustments to save money?
Yes, there's a couple of ways you can, I mean, the state can change eligibility. I mean, there's certain federal requirements, but you can change eligibility.
Right.
You set the provider reimbursement rates for the most part, so you can always adjust reimbursement rates. And there is some ability to require more cost sharing or to, put caps or so forth on the number of days or number of services you get from a certain type of service. So there are flexibilities. I would also note, the General Assembly in recent years has passed additional mandates for Medicaid to cover certain things that are not federal requirements. Feds will participate if we choose to cover them, and you've passed some bills to do that. So that's an example of there's a lot of state decision making in the Medicaid program. So there's definitely things.
There's room to maneuver. So, and to be clear, I know anybody who's eligible traditionally for Medicaid, I don't think we want to be doing a lot of messing with. It's obviously a program there for people who need it. But my understanding is we have families who make as much as $100,000 a year that are getting some level of Medicaid. And I think at those higher levels of income, and that's not $100,000 than what it used to be for a family, obviously, but I feel like that may need to be part of a long-term solution, is maybe a little more cost sharing, maybe looking at some of the mandates. So I was just curious, is that the kind of thing that could save tens of millions or significantly more, or it's hard to say, I guess, unless you talk about what
the devil's in the details. I would just add one last thing, just for the committee, is one of the concerns, you talked about the 90-10 federal match. One of the concerns as you watch what Congress does is, there's been some talk at the federal level about block granting or otherwise changing the Medicaid program. And that's where there's some risk to the state, is if they bring that match rate down to 50% or to something like that, that would be a huge cost to the state. And I think that would lead to more of the kind of conversations that you're asking about, is we might have to think about what, policy decisions to make.
And thank you, Madam Chair. In closing, would you mind if if I need to ask somebody else, I'm happy to, could I get a breakdown of what bills maybe most in the last 3 or 4 years or what things we've passed? Not, you don't have to read them. I mean, if you want to send them to me,
No, I'm writing a note to get you that information.
Thank you. I was confident you might have them all memorized, but if you don't, that's okay.
I do not.
But I would love to, I think it'd be important to take a look at that, just so we know what we've maybe gotten ourselves into. Thank you, Madam Chair.
Senator, if I can add, it's very difficult when we've given mandates to commercial insurers and then say Medicaid doesn't have the same mandates. It can be done, but it's very controversial. I realized I have one question that I didn't get to ask. So, Mr. Romans, thank you for your presentation. We understand that the inheritance tax would disappear under this budget, but we also understand that our county Register of Wills are funded by that inheritance tax. So what's in the budget to help fund those county Register of Wills?
I think it was an oversight in the budget that when they were repealing the inheritance tax, I don't think that it occurred to people that meant the registers of wills who get a share of the inheritance tax were going to lose their funding. So I think I know the administration is aware of this, and I'm sure they will be coming forward with some sort of solution to that problem.
Thank you, Mr. Romans. I don't see any other questions. We truly appreciate your work and your presentation. Thank you for spending your morning with us.
Sure.
And that ends the briefing. Please be back at 1 o'clock.